Hello everyone and welcome to another one-to-one mining investment online discussion. I'm very pleased to be joined today by a fantastic panel of investors with broad expertise across the natural resource and other sectors, of course. We're going to be getting some feedback on how investors are interpreting the economy at present and in turn to develop a better understanding for metals and mining projects. I'm pleased to be able to draw on the expertise of Kayleigh Barker, Director of Natural Resources at BlackRock, Caroline Donnelly, Managing Partner at Denham Capital, and Gervais Williams, Senior Executive Director and MD at Premier Miton. So thank you for joining me today, everyone. Let's start off with looking at the big picture, the macro scene. How long do you think this recession is going to run for? If indeed this is different from other economic conditions that we've seen before, this seems to be hitting consumers rather than the factories first. Yet China, we already hear this week, it seems to be coming out and restarting things and restarting their economy. So I just want to get a touch on what's the global view at the minute from your side, and I guess we'll just go around the houses. So if you could start with Kayleigh, why don't you start us off, please?
Thanks, Adam, and thanks for having me. Yeah, well, I think my view might change on a daily basis depending what data we get out, and there's no real playbook for what we're experiencing right now, so it's very difficult to predict what the future may hold. I think if you'd have asked me a month or two ago, I probably would have been far more downbeat, and I would have said that this thing we would have had way more impact and over a longer period of time. But what we're seeing now, certainly if we believe all the data we analyze, then the number of deaths per country is not, take the US for example, perhaps not millions, so it's not as bad as feared, but it's certainly up there. So I think the overall impact on the economy and what is a humanitarian problem is probably somewhat muted relative to our over previous bearish expectations. But I've also come to the conclusion over the period of this time is that it will drag on further, and we will most certainly get, albeit maybe more localized, but certainly second and third waves. So probably not as bad as feared, but going on longer, and it may take time for us to come back to some level of normality through all of this. And I certainly see that, taking up most of this year and perhaps a good chunk of next year as well before we get back to levels. I suppose the hope is that there is some kind of lessons we learn out of all of this, and that there will be some changes. I think the broad message that I think that it is pretty bad. Things will be down, GDPs will be affected, but there are signs of life. As you mentioned, China's picking up, and I think the economies will bounce back relatively strongly in some areas, but it'll be a choppy market as we go through that.
And do you think some regions are going to come back quicker than others? Well, we know for sure in terms of who's past the peak of this current wave. But what's your sort of take on the situation with the US at the minute, for instance, and their huge unemployment that's come about of this? And obviously China's hard to sort of gauge because there might be difficulties in the data or inconsistencies in what's actually reporting and what we're hearing. But what's your view in terms of the different regions, the UK, for instance, coming out of this?
It's going to be very tough. I mean, we haven't had if we go back to the GFC, that was a situation where it affected a small number of sectors in comparison. This is just affecting everything across the board in different timescales. I think the big powers, US and China. Hopefully what we're seeing in China is an indication of what the future may hold down the track for the US in the next few months, and that things will certainly come back to some level of normality. But I would come back to my earlier comments that there will be fallout from this, and there's obvious sectors that will be affected, like the airlines, for example. We know that that's going to take a lot longer to recover. But I think our sectors in particular, will recover quicker, and we've already seen that as some countries obviously deem mining essential, and we've seen operations start to ramp back up to levels they were enjoying previously.
Yep. Let's come back to the mining more specifically in a minute. I'll just jump over to Caroline. You're over in Houston. What's the mood like there, and what's the view from Denon at the moment in terms of these the big picture that we've been touching on?
Yes. Good morning, Adam. So, I think the US is almost a bifurcated tale in that you have New York, and that's obviously a hotspot, and there is I don't want to call it a crisis, but certainly things are very challenging in New York. And then I think you almost have the rest of the US. And if you look at, the infections and the death rates, etc., it's much, much lower in other parts of the country. So here where I am, restaurants have opened back up, admittedly only at 25% capacity, but people are going out and about. Retail stores have opened up, personal services like barbers and hair salons and things like that have opened back up. So we're actually starting to see quite a lot of activity come back into Houston. I think for a city like Houston, which is very much oil-based, that to me is going to be the major swing factor as to what happens to this very localized economy, and then how that impacts the rest of the US. When we had the GFC, there was obviously, as Katie said, there were different sectors impacted, but you didn't have oil at such a low level. What we have here appears to be unemployment is sky high, and that seems to be a more short-term issue, except for, things like airlines, which in the new normal, those sorts of things may have a completely different outcome. But for retail and consumer style goods, I think as people go back to work and start doing what they were doing, those will pick back up to their regular levels. Then you have this benefit of the cheap oil price and your ability to move goods and services, and electricity is cheaper, and everything that goes with that, logistics, transport, etc. And I think it's going to be very interesting to see how that all plays out, along with the large amounts of money which have been pumped into the economy in a time when, frankly, the banks are in sort of reasonable shape. The banks have been through the GFC, come out the other side, they've obviously met liquidity ratios, etc. So you have an interesting dynamic here of banks in good shape, lots of money coming back into the market, economy starting to open up in parts in the US, and then a very cheap oil price and how that feeds into business moving forward. So it's going to be interesting to see how those dynamics play and how this all unfolds. Yeah, definitely some key points there that I'd come back to on the lending side and also on the oil side. But Gervais, just to get your quick take on the big picture as well. How have you been seeing things here from London?
Yeah, it's interesting because I've been sort of waiting for this moment, not because I wanted a pandemic, obviously not, but we've been, in a period of globalization which lasted for about 20 or 30 years, and more recently we've been in a period of sort of globalization coming to an end. We've seen quantitative easing distorting market prices, we've seen a lack of productivity, we've seen people not getting the wage rises they got used to, and as a result of that we've got to a stage where the electorate are voting in much more nationalistic governments. And I think this is what's been the pattern anyway, irrespective of COVID. I think COVID has probably accelerated the change. So what we have now is unfortunately a global recession, which I think will catch an awful lot of businesses overgeared. So I think there'll be quite a lot of companies which get caught out financially. I think quite a lot of companies go bust, particularly private companies. I think there'll be quite a lot of bad debts around. I think governments will continue to throw money at the markets as they are now, but I think banks will start putting the cost of debt up. I think specifically you'll find that banks are much more prudent in their lending policies as they don't want to get defaults going forward. As a result of that, I think we've got a sea change, actually. I think this is a major change. I think unemployment will be much higher after this. It won't just go up, it won't come down as much as people think. I think globalization will be a thing of the past. I think specifically global growth will be very weak in the next 10 or 20 years, maybe some recession, some growth, but not very much either. And overall, I think we're in a major change of trends. And specifically, I think things like commodities, strangely enough, are going to get more important. You can throw notes of all fiat currencies at this thing, but in a way, all that you do is you devalue money relative to real things. I think real commodities will start to become more important. I think mining companies actually may be well placed for this uncomfortable future.
Yeah, so systemic change, but not necessarily a bad period for mining and metals. I mean, but what about how would you address the fact that supply and demand shocks have happened simultaneously? You know, particularly in commodities, metals and mining. You've got forecasts being rapidly revised lower. Where does the institutional money? How do you view those forecasts? And yes, it could be a good period for mining companies, but would it be a good period for all mining companies, given those supply and demand disruptions?
Sadly not. I mean, as I mentioned, I think there'll be an awful lot of companies going bust. I think, as we've seen, commodity prices have been flying around. If you take out the precious metals, a lot of commodities have come down considerably. Unfortunately, it could come down considerably more depending on how bad the recession is. But I do think that leads to a Darwinian process where a lot of marginal players unfortunately go out of production. Many other companies, which are probably viable businesses, go bust because they're over indebted. And so I think those which are listed can take over assets from the over indebted for knockdown prices, put some working capital and get some very quick cash payback. So I think the win bigger. I think the losers lose worse. But ultimately, you get quite a lot of capacity coming out through the Darwinian process.
Yeah. We'll come back to that in a minute in terms of who those winners and losers might be. But Kaylee, do you agree with the sentiment around this Darwinian process is going to be reshuffling exactly who's going to succeed and who's going to endure this? There was some chat yesterday about on the panel that I moderated. It was around resilience was a word that was thrown up a lot. Are the resilient companies really going to shine through? Is it going to be quite clear who those are going to be, particularly to mining metals?
Yeah, I think we've already seen that really in quite a lot of regards. You know, the big guys in both gold and on the industrial metals and diversifies, we've seen them outperforming a lot of their mid-tier and certainly junior peers. Some of that we've seen some of that reverse, but I think that's a fair reflection of how they're handling the crisis. If you think of the sins of the past, where companies were over indebted, you know, and they've learned those hard lessons pretty well ever since, you know, we've bounced back from what 2016, I guess it was. And you know, to Gervais's point, the indebtedness of a lot of companies in a broad number of sectors hasn't really applied to particularly the major mining companies. It's more the junior companies. You know, they need, you know, let's say they're on the exploration side, or you know, they're in development phase, that they need access to capital, and that capital is few and far between. I mean, we have seen evidence that there is some access to it, and if you've got a good project and you run your company well and you're well positioned, then you've got a good chance of getting your hands on it. But you know, we're as I think Gervais eloquently pointed out, it's a big industry, and there will be fallout from that. And I don't think that Darwinian process, as he put it, is a bad thing, because you know, we are full supporters of good companies, good citizens. And I think broadly across the mining space, you know, particularly looking at the big guys, they've handled themselves excellently. I think if they'd have perhaps been more promotional and messaged themselves more promotionally, they could be showing themselves in a fantastic light, that they've been extremely good citizens and handled their business phenomenally well throughout this crisis.
Yeah, and do you think that's the big miners across all commodities, not just the sort of Barrick, Newmont, you know, who are doing well with the gold price at the minute? You mean across, you know, Rios and Vale and other large caps?
Yeah, I mean, obviously there's exceptions to the rule, and some doing better than others, but on the whole, absolutely. I mean, I spoke to a large gold company today, you know, and they made that they had one of their operation or key operational areas are the native people that are very vulnerable to the virus. So they closed down those operations and moved them out early. So that's just a sort of anecdotal evidence that I think they've been handling it very well. They've been following government guidelines, which not all of us have in London, and they've been using the opportunity to follow their other themes that they've done for decades, but not necessarily messaged that well, of sustainability and social license and all those other important things that come along with mining that are not always highlighted as perhaps well they should be.
Caroline, what's your view on the sort of consolidation or Darwinian process in the sector at the moment, and also how might private equity react or respond to that in terms of your sort of your long-term view that I often hear you talk about? Does this really dramatically shake that up? Is there an even longer-term view having to take now in terms of getting your portfolio companies to where they need to be resilient to this situation?
Yeah, Adam, I think there's almost a bifurcation in the market. You have the major miners who, as Kaylee said, sort of 4 or 5 years ago, discovered that it wasn't production for production's sake. It was actually production for cash flow sake. And, a number of companies cleaned up their balance sheets, sold off non-core assets, made sure that the ounces they were producing were generating positive cash flow, which meant that coming into this pandemic, those balance sheets are actually in pretty good shape, and they can afford to withstand the downturn, and they have access to capital in the form of their revolvers and longer term debt because they spent all those years cleaning up the balance sheets. Then on the other hand, you have the juniors who frankly have always relied on more of the sort of retail market in order to raise their capital. And as we at Denham have been saying for a number of years, we're starting to see, and we've seen it more and more, that capital is formed in the junior market just in a very different way. The retail investors who frankly used to provide all the capital for the juniors across the board are no longer there. Yeah, I think there are some bright spots here and there, admittedly, but across the board, those retail investors are just not putting their money into mining. When you look at the S&P and you could buy an index and it's flying, I mean, frankly, why would you take the junior mining risk? So, what we're starting to see is more private equity coming into the space. Obviously, there's royalty streamers, there's those sorts of groups who've been around for a while. But I think we'll see private equity doing more deals. We'll see more club deals amongst the private equity funds where the funds team up and do deals together.
Right,
We've seen parts of that here and there, but not a huge amount. I think we'll start to see more of that going forward, and less of assets being funded fully in the public markets. To Kaylee's point, there are exceptions to all these things. So, over the recent past, we have seen development capital raised from certain smaller mining companies. We've also seen, in some instances, shareholders providing debt alongside the development equity in order to get the assets into production. So that's a bit of a change where, you've almost got public market investors acting more like private equity and investing across the capital structure. So I think they're those examples. They're few and far between. I don't see that as being a broad-based answer to how do juniors move their projects forward.
Yep. Understood. Surely with precious metals or with gold looking to be the sort of safe haven asset at the minute, that might trigger a little bit more activity on the retail space or on the public markets in terms of gold, maybe mid caps and juniors. And then also with that, do you feel that this could trigger another growth period of M&A actually off the back of that as well?
Well, we've seen an immense amount of M&A in the gold space just over the last couple of months. There was a merger of equals announced yesterday. There was a takeover. There was there's a bit of a bidding war going on for Guyana Goldfields. So there's a lot of activity in the call it mid-cap space in the gold markets. And when you have the gold price over $1,700 an ounce and you have the Aussie dollar at like 62 cents, and you have the Canadian dollar at 71 cents. I mean, it's not surprising. The gold price in Canadian dollars and in Aussie dollars is sky high. So, I think we will see more of that. It does remain to be seen, though, whether any of that trickles down into, the more junior developers and explorers as they try and move their projects forward.
Yep. Gervais, you've got obviously a knack for picking small caps in the resource space. Do you think that some of that capital is going to come down to the smaller, the junior mining companies, whether that's gold, gold juniors or other commodities, or perhaps that's not so much the case right now?
Yeah, I mean, I think the area which is doing well at the moment is very much precious metals, not just gold, silver, platinum, and others. And there are some smaller quoted companies. I think what's interesting about the globalization process is that actually most investors have narrowed their investment universe. The professional investment universe has actually often migrated up to mid and large caps, and they have a large number of different holdings across the world in this area. And if anything, I think small quoted companies, small mining companies particularly, have actually found it pretty difficult to exist over recent years. And in fact, the London market is quite unusual in still having a vibrant universe of small and micro cap quoted companies, as well as mid and large caps. And there are some small gold companies in there, and there's some other companies in there and other assets as well. I think going forward, I think if world growth is stagnating, if we don't get much global growth, we won't necessarily find that many of the big companies produce much return because there's not much world growth. Then you will find actually investors start becoming more alpha sinking. If beta's not doing it for you, you're going to need to move into individual companies which excel, stop picking in the old-fashioned way. And I think that will bring actually more interest into some of the small quoted companies, not just because they're small and they sometimes get lucky, but actually if you are going to ping an asset which has gone bust, you're going to raise some cash to bring it back into production, you need to put some working capital in. Sometimes if you're in the middle of a recession, you make out like a bandit on that. Sometimes it's good for big companies which do that, but they're quite big, and small acquisitions don't make much difference. But for some small companies which do it, it could be transformational, and they generate outstanding returns. And this is what happened in the 70s and the 60s before globalization, and this is why small companies actually outperformed. They put cash in, they got transformational returns, and they generated more cash payback, more dividend growth than the main market. Clearly, we have had dividend cuts on a wide-ranging basis in the UK and around the world over recent months. And on that basis, we think actually going forward that cash and the ability to generate cash paybacks are going to become more important. Clearly, gold is an area where that's happening now because you've actually got the gold price moving up at a time when the rest of the world is in a bit of recession. But most particularly, I think there will be other assets, other parts of the mining sector which become in shortage of supply, maybe because of electric vehicles or the ongoing development of all of that. Also because you'll see ultimately better returns. We have a slide which we can show, which actually shows that if you look at the very long term, since 1955, this is since data was first put together in London in a detailed and regular basis, you find that the smaller the company, the better the performance. Now that's been happening over the last 30 years, but so what? You made out like a bandit in any asset you chose. People didn't need small companies. I think going forward, I think this factor is going to become hugely important. I think there will be money moving down the market cap range. I think professionals investors will start to get involved. I think private investors, to be fair, there's some which are still involved even in that sector at the moment. So what you can see in that slide is this is a long period, over 60 years. You can see that bond yields at the left-hand side are fairly low. The all-share index in the middle, about 6.4% per year. And then as you get into the mid-cap, the small cap, and the micro-cap, the Numis 1000, you can see that you get compounding sort of 4 or 5% extra return per year from the bottom end of the market. And obviously there's stock picking which can add value to that too. So we think this is going to become horribly relevant at a time when actually main asset returns on nearly all assets are going to be pretty paltry.
Yep. What about the liquidity for small caps that's available there? Is that a challenge right now, or if we're taking a long-term view, you think it's less of an issue?
I mean, whether you like it or not, the whole point about small quoted companies is they are quoted. And therefore the price, you might not like the price, but it changes every day depending on buyers and sellers. It's not like some of the other forms of investing where you're depending on models and such like. Specifically, we've had drip money coming out of small companies pretty much for 30 years. So if anything, there's been too many sellers, not enough buyers at a marginal basis. And so liquidity has been, can you get out? I think actually going forward, we'll start to find at certain periods, there'll be periods when people want to put capital in, but there's no one selling. nearly everyone in the institutional world who wanted to sell has already sold. You've got companies which are successful, which are coming through well, and that will start to lead to drip, more money going in than coming out. And the illiquidity people will be worrying about isn't so much that they can't sell. They can sell all sorts of things quite quickly. They'll find actually they can't get money in. It's a small sector. Small amounts of money make a big difference. Transformational return. Small companies in the US and other places around the world are starting to outperform.
Yeah. Okay. Caroline, what's your views perhaps on that getting out there? What's the private equity view on sort of now? Obviously, you need the exits to keep a healthy sort of environment to keep up the exits. Do you see now as a time just to hold and to focus in on the projects, or is it looking for that M&A as the exit?
Yeah, again, I think it depends on what stage of the business you're in, and the development stage of the asset. I think this is the time when people should try and push forward with their projects, to the extent they can under social distancing and other restrictions. But if you're in a company which is doing a feasibility study, like, finish it, get it done. There is absolutely no reason to stop at this point. We follow an approach where we bring projects through into production, where we have development assets, and we're carrying on with that. The blips and moves in the market for us are frankly almost, I don't want to say irrelevant, but they're relevant as far as commodity price is concerned. But as we move down a path of bringing our projects into production, provided we can still see good returns at wherever the commodity price may be, we will carry on with those projects. And certainly, my personal advice to companies is, if you can carry on and you can push through this, then push through. I think we're very bullish on the copper space and have been for some time. Obviously this COVID-19 issue has had a major impact on pricing. Fortunately, nothing like we've seen in oil. So I think we can all feel quite fortunate that we're certainly not in that sector at this point. But we still remain quite bullish on copper. And for those who can continue developing their projects over time, I think in the, call it, year to 2 year, maybe 3 year space, we should see a big pickup in the copper price, which hopefully for companies who've managed to carry on is the point in time where they're thinking about coming back into production and looking to raise their construction capital, or if they've been successful in raising construction capital, are actually coming into production at that point. So, for us, it's a case of, we don't view that now is a particularly good time to sell, but it's certainly a very good time to be continuing with your projects and not putting things on hold whilst you wait to see what happens with the markets.
Yep, that makes sense. Kaylee, what's the view from BlackRock? Because obviously you have a different style in terms of where you see value within different types of mining company. Are you seeing the value perhaps maybe more in the mid tiers at the minute, who've got that development capital in place and are cracking on with their projects, rather than some of the riskier smaller caps that Gervais has been championing?
Yeah, I mean, as you know, we invest right across the piece. I mean, by virtue of the size of our funds, liquidity is always a concern for us. But we've invested up and down the spectrum, and we have done for the 30 odd plus years that the funds have been running. I mean, I think what's most exciting, I think, I think the big caps will continue to do well, even if, as Gervais put it, a lower global growth world is there. They're in good shape to generate. They're right down the bottom on the cost curves. They're in good shape to generate decent cash flow and pay back shareholders. So I think those all continue to do well, but they have outperformed in the market, and we've already seen a slight rotation into mid tiers. Overall fund performance has been heavily dominated by growth. We've seen that growth factor investing has really been where the market has has benefited for the last 10 years and across all sectors. But there is a gentle rotation into value, and I think that will come into play and will help the mid caps, certainly. I think, you know, where we've always held space for, and there is sometimes some misconception that we don't do a lot of small caps. We certainly do, and we always have done. As I said, there's just we just have less capacity in some instances, and there's only so small we can go. But what we're very excited about is some of the exploration success that we're seeing across the world. And I think, you know, if we're right, then there is lower global growth. You know, we don't necessarily need the next, I don't know, let's call it small, average quality mine in the world, because we just quite frankly don't need the metal, and we certainly probably don't need it in gold. So we don't get, I'm not excited about those kind of opportunities. Developers, we've invested over a number of years, helping companies develop their projects, and it's been a very mixed success. Lots of projects have been complete disasters to just not coming in on time and budget, not delivering as expected, and that hurt us in performance over the last few years. So we've tended to move away from that market to some degree, and we still do it, but we certainly less emphasis, and we've put more emphasis on the earlier stage exploration. You know, companies that are really looking for sort of world-class type assets in exciting or new frontiers, new jurisdictions, new greenstone belts, whatever it may be. I think they're getting, you know, the excitement is that they're actually finding good stuff and getting a reward for it in the market, which we haven't seen for quite a few years. So that area of it just looks very interesting to us.
That's good and exciting. Yeah. Are there any particular commodities within that you're quite bullish on? Caroline remains quite bullish on copper. Is that quite big for you?
Yeah, I think copper's got a bit of a haul to come back out of. I mean, on the longer term basis, yes, battery demand will help. Yes, not finding and not developing large scale mines that, you know, we've enjoyed in the past, I think will help the copper price. But do I think it's going to go back to the heady days of $3-4 per pound copper? I think that's unlikely. So yeah, I expect to see a bounce from here. I think it's probably the best placed of the all commodities. Iron ore has been incredibly resilient, and that, you know, that's probably due to some softened correction over a period of time. I think that, you know, gold, this is the environment where gold's doing what it should be doing, you know, and we haven't seen that for 7-8 years. We haven't seen this. So finally, gold's got a response. So you've got to be, I think, you've got to be bullish on gold and the PGMs as well. In some areas like palladium, I think that looks extremely exciting as well. And the battery narrative, I think every day again, you know, but probably not just now until the economy picks back up and we see EV demand return to some level of normality again.
Yeah, I was going to say, how much does these automotive, you know, purchasing of vehicles, consumer patterns are going to change? I'm not going to buy an expensive EV necessarily if I'm on furlough or there's disruptions in the markets for me. And then you have the aviation industry as well, the engines and the metal demand there. How much does that disrupt battery metals, palladium, for instance? And if it does massively at the moment, is that a short-term effect? Obviously, it's hard to say, but do you see that as a big alert?
Yeah, you know, the auto sector's awful, and I think it will take a long time to recover. And then, as you rightly said, it opens up the question of, I think, two big questions. One is certainly how we travel, and do we need, you know, we've done away with traveling quite well over the last few months, so perhaps we don't need to travel as much, and we certainly don't need to go out and immediately buy a brand new, very expensive EV. So you know, that recovery in that sector is going to be, I think, relatively tough. And then, does it change us permanently how we view the sector? You know, do we go back to that sort of the idea, okay, electrification is going to happen, but, you know, is there going to be more car sharing? etc., etc. So I think I'm still very positive on that space. I think the future of transportation and electrification, I think, is very real and very going to happen, very much going to happen. But I think certainly, this has delayed the prospect of it. But as we know, when new technology gets adopted, it's exponential. We've seen that with mobile phones, etc. So my view is it's coming. It's just probably coming later.
Yeah, it's a speed bump, to paraphrase. Gervais, do you have any views on sort of automotive recovery, but also oil price? I mean, in one aspect, oil price being so low is bad for the economy, but also it's great for the mining companies' capex. If you're out there in the middle of nowhere with diesel generators, or as Caroline said, transporting goods over long distance, this could be a great time to increase the value of your company in that respect.
Yeah, I mean, it's been quite interesting, isn't it? The dollar's been quite strong, so most emerging currencies have actually had relatively weak currency, so the production costs in local currencies have often been quite low, and that's been a positive. And of course, we've had the combination of very weak oil price, very weak diesel prices, thereby energy consumption of many of these mining companies has also been unusually low, and that's reduced the unit cost of mining quite a bit at a time, in some cases, particularly the precious metals, when metal prices have been rising. Coming back to your electric cars and such like, I mean, to be honest, I'm much more cautious than the average on this. It's quite a popular area. A lot of people have been looking for lithium and copper and all the other aspects which go into batteries for cars. And if anything, I think there's probably been too much interest in this area, and I'm a little bit cautious really about unfortunately too much capacity coming on at a time perhaps when world growth is stagnant, and most particularly you're going to find that unemployment's raised and people maybe are more cautious about buying a new car or changing the current car. So from that point of view, I'm probably more cautious. On the other hand, I'm probably much more upbeat about precious metals. There's a real danger that if we issue so much money that people lose confidence in various currencies as a fiat currency, as a store of value. And there is a danger that we get to that stage, then you could find things like gold and other precious commodities could actually go much higher than we think. Like, the gold bugs could be right for once in a while, and suddenly oil price might go up a bit, and energy costs might go up a bit because we've had too little investment in there. But at the same time, you could find the gold price going through 3,000. I was talking to one particular small gold mining company, and they were worried that the gold price would go through $20,000. Crazy. Why were they worried? They were worried that they would get special extra costs coming in from their host country, which suddenly took a windfall tax on the other side.
Right. I'm talking their own book a little bit, perhaps.
Well, maybe, but I mean, the whole point about markets is they're not smooth curves. They do have zigs and zags in big ways, and commodity prices have bigger zigs and zags than most other things.
Yeah,
it's a very fair point, Gervais, actually, because there will certainly be, if commodity prices stay up here, there's certainly going to be some comeuppance. And I do see we've already certainly had some whisperings of it already. The higher taxes, corporation income, or whatever from countries. I think that's inevitable. And to Gervais's point, that if commodity prices stay up, that's almost a certainty.
Yeah, and certainly not unusual in the mining sector. Again, those sorts of things come in waves where one country sees that there's an opportunity, and so a few jump on the bandwagon, and that almost destroys their credence with the investing community, and then it takes a while to settle, and then things come back again. And so we certainly see the impact of taxes and royalties and windfall taxes and those sorts of things. We see them coming and then fading into oblivion, and then coming back and fading into oblivion. I think the unfortunate fallout from that is that investors then view those countries with a fair amount of caution when they're considering their investments, which in a number of the more challenging jurisdictions, mining could be a very large portion of the economy, so that's not good for anybody.
Just thinking back to what we were saying about gold, do any of you hold physical gold within the funds? And is that ratio changing at all at the moment?
So we don't hold physical gold. I mean, the whole point about gold is it doesn't have a yield. And whilst it's nice if the price goes up and you make good money on it, ultimately, it's really nice to have a mining company which is investing, getting a cash payback, putting a good yield on the table, and growing that dividend yield at a time when other things aren't growing. So, if anything, we think actually some of the mining companies are better investments than the gold itself.
Excellent. Yeah.
Yeah, likewise, we don't have gold. It would be difficult with our mandate in any case, but I see far more opportunity. Over a period of time. I mean, if you look back 50, 60 years, on average, probably gold has done better than equities. But sure as hell, there are peaks and troughs through that, and the peaks are huge. So if you pick your timing right, the leverage you get on an equity is far outweighs buying gold. So that's certainly what we're all here for, to pick those opportunities.
Yeah, and it's the same for us at Denham. We also don't hold the physical commodity. We would far rather put our money into, as Gervais says, into a gold mining company where we can get capital back, return that to our investors, earn possibly an equity style return if we're doing an equity investment, instead of sitting on something which may or may not go up and down in price. And frankly, you then have the costs of holding, which are obviously minimal, but you also have the cost of selling, and you have the security and other issues that go with that.
Yeah, indeed. Okay, so I wanted to touch on another point that was very much a dominant theme of the investment sector as a whole, not just mining, up until now, and that's ESG. Do you see within the recent economic conditions and perhaps a rush to see from shareholders seeking out value, do you see the lights dimming a little bit on the ESG mandate, or is it more a case of that that's very much here to stay, but other elements are taking more of a center stage at the moment?
I mean, if I was going to answer that one, I would say actually that ESG has become much more important to clients in the last 18 months. I mean, it was always there. The whole point about governance and dealing with the local country and helping to make sure that the local people aren't disadvantaged in the immediate area. This has all been about minimizing risk, and many of us have been doing it before ESG as three initials were put together. I think the whole point about climate change is that that's come on the client's agenda generally in a big way over recent years. I don't think it's going to go away, because the problem isn't going to go away. And if anything, I think it's just going to be another thing we need to worry about in conjunction with a lot of the other things, perhaps slowdown of world growth, potential recession in the short term, all that kind of thing. So going back, I think what's interesting about that is I think that as that issue raises, actually many commodity companies, particularly mining companies, are actually ahead of the mainstream in this area. They've had to deal with many of these issues on an ongoing basis for many years. Specifically, I think when it comes to actually measuring the CO2 emissions, or perhaps the water they're consuming, or indeed even the energy they're consuming on a per ounce basis, they're way ahead of many of the competition. And we have certain companies in London where I think they're actually exemplars of how things should be going forward. And when you come to sustainability, with Newmont and others now, you start to find the senior management team are incentivized only 5% at this stage actually on sustainability goals. That's definitely not going to unwind. So I think this whole agenda's grown. It's very substantial. It may be that some companies fail, not because they're not meeting the ESG agendas, but because they run out of money for other reasons. But I do think the ESG agenda, particularly climate change, is with us for the duration, and that's a good thing probably. And I think particularly quoted companies in London are well placed to compete with many others in other sectors in this agenda.
Yep.
Yeah, and I think that just brings it out to the fore. I think the virus situation is going to bring it out to the forefront even more. Certainly not immediately, because they're more worried about safety and protecting their staff and their business at the current. But I think once we start to emerge from this and return to some sense of normality, I think it's going to come back with an even stronger vengeance, because people don't remember so much about what you did, but they certainly remember what your behavior was through a crisis, through history. So this is the chance for mining companies to shine, really. If they behaved as good citizens, and governments know that, and investors know that, through this period. They have more confidence in the way they handle ESG issues. You know, they as Gervais rightly said, they've been doing it for decades. It's nothing new, particularly, but what's become more apparent, and as I alluded to earlier in the discussion, was about messaging. I mean, the big issue that we've got in the industry is just like we've seen with other metrics, we just need everybody to come together, the whole industry to come together, and I would include us in this bucket as well, to actually be more standardized in the way it's reported and more clearer in the way it's reported, so that it's just so much easier for investors to and the general public to just understand who are the good citizens and who are the bad citizens within mining and compared to other sectors. And I think once we get that right, you know, the message will be hit home very, very hard.
Have you seen the reporting standards coming together and improving? There's various different initiatives spearheaded by various asset owners and groups. Do you feel there is good progress being made?
I think absolutely. Sorry, Adam. Yes, absolutely. I mean, there's been excellent progress made, and you know, you only have to go to pick any one of the major mining companies and look at their sustainability reports. They're fantastic documents. But the problem is that that's exactly what they are. They're big documents, and then you go to another mining company and it's another fantastic big document, and they're all very different. And what you really just want is, like we've had with, say, I don't know, the advent of the all-in sustaining costs in the gold industry. You want a simple handful of metrics that you can benchmark these things on quickly. And then if you want to dig in behind the detail, if things flag up, then you can go ahead and read the report. So the advances made have been staggering, but there's still much more to do, I think.
Yes, I have a slide, if you want to put it up, Adam, to show how the governance agenda is developed in London, and it just shows really, you know, from the Cadbury report onwards, nearly 20 years ago now, how we've had all sorts of iterations and such like. And this is how the conversation goes. You get different people with different metrics, and you do find that as they, you know, as new developments come through, people try and set this, and there is a common language. Ultimately, we need a common language where terms are defined, and when we mean, you know, how much CO2 it is per ounce, it includes all your suppliers as well as your own emissions, etc. So I think we're going to see the same kind of iteration on this with the climate change agenda. As I say, I think it's going to be something which is going to be quite front of mind. I think those companies which are meeting those criteria, and there are a lot of quoted companies are probably ahead of the crowd here, will find actually that there's many more investors who are willing to support them, not just in all cap portfolios, but actually in some portfolios which are delivering climate change benefits. You know, a lot of these commodities are helping in terms of, you know, reducing CO2 in electric vehicles and other things. So there are some positive climate change impacts here, which some companies hopefully are going to meet very, very significantly. So it's going to be a changing agenda, a rapidly changing agenda, but just as we saw with governance, different reports, different ideas, and a common language at the end of it.
Yep.
Yeah. And on the, you know, on the private equity front, this is something that we've been doing for many, many, many years. You know, as we progress projects, you just have to do these things. You know, it's not as though you can ignore your communities. You can't ignore the environmental aspects. You know, frankly, it all comes down to making money at the end. And if we are going to be able to exit our companies, if we are going to be able to return capital to our investors, we need to do these things. And as I say, we've been doing, you know, the correct environmental work, you know, looking after our communities, making sure they're involved, they know what's going on, you know, good corporate governance, etc. That is, you know, these are some of the absolute bases on which we start from an investment. You know, I think it was Kaylee who mentioned it earlier. The problem, I think, has been in the messaging, in that ESG has obviously been important, but it hasn't been something that investors have focused on. So, you know, going back again 4 or 5 years, the big focus was on cash flow rather than on production for production's sake. And so that was where people focused their efforts. And, you know, you saw the outcome of the all-in sustaining costs and things like that in gold. I think what you're now seeing is people are far more focused on ESG. So that's almost the next wave of information which needs to be presented in an appropriate fashion so that investors can make decisions, and certainly for the listed companies, so that the larger fund managers can make quick decisions based on, you know, whatever metrics they need to see. So certainly what I've seen is reporting does seem to become more standardized. There seem to be a number of companies out there that are able to, you know, pull all this data together and actually provide it in standardized forms to banks and fund managers, etc., and people who use that information in that format. And we've seen some of the larger data providers actually buying up these smaller companies that provide this data so that they too can offer that service. So, you know, I think it is something which is obviously absolutely critical. But I do also think it's a case of messaging, that it hasn't really been a focus area for investors. So the companies haven't been very good at telling people what they've been doing.
I think companies are getting better though. I mean, you take the sustainability reports are there. I mean, if you think back to the real reason we were so interested in this isn't just because we want these companies to be good, but if they get it wrong, and the government of their country wants to get rid of them, if they are, you know, not being good citizens, if they've got a bad accident record, then they find that the mining license is withdrawn from them. And I think the same will be true for climate change agenda going forward. So it's a hygiene factor, which is actually just good business rather than anything else.
Yeah. And okay, so we're coming to the end of our sort of 45 minutes on this, but I've detected some really positive undercurrents across the whole discussion for metals and mining, really. Do you each have perhaps a minute just as a summary point of any positive stories that coming out of this, or anything that you're particularly bullish on, perhaps it's commodity or the sector as a whole, just to wrap us up?
Shall I start? I mean, the main thing is that I'm kind of worried that I'm going to get some takeovers. I've had loads of takeovers, not just in the mining sector. In many of our funds, we've probably had 20 takeovers in the last 18 months, and that's because UK is a bit cheap. Small companies are particularly cheap versus the UK, and it's quite easy for international investors with strong dollars or whatever to buy our companies. So, for example, you know, we've got a holding in one of our funds, one of our largest holdings, a company called Kenmare. It's an ilmenite producer. They've spent the last 15 years, 1.1 billion putting the mine into production. It's got 100 years of production, but it's still in a market cap of about 250 million. It's on a P of 10 dropping to 3, and with almost no debt. This is kind of madness. The last thing I want is for these companies to be taken over.
Okay. Hold on. Yeah, Katie.
Yes. I was going to say something similar. M&A is a bit of worrying. I think there's a fear in the market that size equals relevance, and that's certainly the case in a lot of instances for the generalist investor community as well. So there is a size component, but I don't think you should be merging just because of size. You know, that doesn't make any sense to me. If there's real synergy, then obviously mergers have their merit as long as they're not destroying value in the process. I think, you know, broadly speaking, I'm positive about the industry. I think it's going to be a rocky road over the next year, maybe two, but there are some real bright spots there, and I look forward to seeing more of them appear. And what this pandemic is doing is opening up some real opportunities and arbitrage for these kind of investments, and I look forward to seeing more of them.
Yep. Caroline, did you have a take on that? And
yeah, so for us, we too are bullish on the industry. You know, we deploy capital into the mining sector. That's our mandate. So I think we need to be bullish on the sector. You know, to like companies out there, as I said earlier, you know, to me, it's a case of try and progress as much as you can. You know, we are seeking to deploy capital into this market. Nothing has changed for us as far as that's concerned. Obviously, slightly more challenging given, you know, travel restrictions, etc. But for us as Denham, we are carrying on with our investment activities and, frankly, actively seeking opportunities.
Fantastic. That's good. That's what we want to hear. Okay, well, that takes us to our time. I'd just like to say thank you very much, everyone, for joining me and giving me your thoughts and the overview of the market. It's been very interesting and very good for our viewers to be able to get this industry feedback. So thanks, Gervais, Kaylee, Caroline. Thank you very much.
Thank you.
Thank you, Adam.